but we're definitely appreciative of your time and the fact that you're willing to meet us here in this rather small and intimate setting. Certainly you're used to the larger conferences, so we appreciate your versatility. So on Friday, NASDAQ announced that MSTR would remain in the benchmark NASDAQ 100 index. So congratulations on that news. Your response on X was that Bitcoin hoarding will continue until the complaining stops. Can you explain a little bit of the backdrop on why you posted that?
There was just a snarky headline in Reuters where they said Bitcoin hoarder strategy remains in the NASDAQ 100. And it was like fake news because there was never any intention of removing us from the NASDAQ 100. And it's kind of like it's a backwards kind of insult to suggest that the company just hoards something, and just reminds me of what is the insult of people doing anything intelligent that you don't understand. You just call them hoarders, like the people that hoard food when everybody else is starving to death or whatever. They think you might need it. But yeah, we're not a hoarder. What we are capitalists. So the most fundamental premise is Bitcoin is digital capital, and a lot of the traditional finance establishment doesn't understand capital. And so they don't recognize a capital asset when they see it. So we're acquiring Bitcoin as capital the same way that you might acquire 3% of Manhattan. So say you believed in Manhattan and you go and you buy up 3% of all the raw land in Manhattan, right? They would call you a Manhattan real estate hoarder. But it was never our intention to hoard the real estate in Manhattan. It was the intention of people that bought up Manhattan to develop a great city. And eventually you build buildings on that real estate, and the buildings have cash flows, and those are credit instruments. So our company believes Bitcoin is cyber Manhattan, right? It's a place that one day everybody on Earth will want to put some of their money. We think it's the greatest city in cyberspace. It's the greatest digital property. Just like if you go to Manhattan and you ask people that live in Manhattan, they think that their city is the greatest city, not just in America. They think it's the greatest city on Earth, and people have been buying Manhattan real estate since 1650. Every decade for 300 years, and they keep paying more than the previous decade paid, and it's never been a bad idea to buy Manhattan because it is the greatest city. So, but no one ever called a Manhattan real estate developer a land hoarder, I don't think. Maybe they did, I don't know. But you know, we think that Bitcoin represents the apex property of the human race, digital property. And our rationale is, if it is the apex property in cyberspace, it represents economic spectrum. It's like, you know, once upon a time, people bought up all of the radio broadcast rights over the United States. And you know, you might have called them, you know, spectrum hoarders. But you know, without the spectrum, there would be no AT&T or Verizon. You can't have mobile phones. So you need the spectrum. And so we view Bitcoin as like economic spectrum. And we think it's just going to get more scarce and more valuable over time because there's a lot of money in the world. And as people want to move their money in cyberspace, either through cyberspace or into cyberspace, they're going to want to buy up that spectrum. And so our company's been accumulating it with an eye toward developing it. And there are a lot of ways to develop capital. If you had $50 billion of capital, you could use it to launch a commodities exchange. You could trade derivatives. You could use it to underwrite insurance. Insurance companies have capital. You could turn it into a bank, and you could use it to buy consumer loans, or you could buy commercial loans. We have chosen to use it to create and sell credit. Another way to say it, you've heard of annuity companies that actually create annuities. You can buy an annuity, they'll pay you 7% or 8% or 6%. We're in essence creating annuities. And the most famous one is STRC. And it basically is a digital credit instrument that right now pays 10.75% dividend yield monthly in cash. And the way we do it is we invest that capital into Bitcoin, which is appreciating faster and we scrape off the first 10.75%. We pass it through the credit investors, and because we are the capital investors, we hold the capital, we take the long view, and if you have enough capital and you have a long enough view, you can strip the volatility and the risk off of the instrument and off of the credit investor. 80 or 90% less risk, 80 or 90% less volatility, and you can extract the dividend or the annuity stream they want. The remainder goes to the equity investor. And you know, generally, if you were in the business of creating annuities for people, you wouldn't just call the company a Bitcoin hoarder, right? Any more than you call, you know, the related company a land hoarder. Right? That's not what they do, right? They're creating buildings for people to live in. And
but you're a hodler for sure.
Yeah. We're just believers. Again, just like if you ever met someone in Manhattan, you ask them if they're ever going to sell their apartment, they're like, sell it for what? Like literally people that have a nice piece of real estate in Manhattan will say, I'm giving it to my heirs, and they'll give it to their heirs. It'll be in the family for the next 100 years, because every place on earth is a step down. And all you got to do is go talk to someone that's a big New Yorker. You'll hear that over and over again. So our view is, yeah, this is the apex property, so we're going to develop it and we're going to enhance it over time, but no, we're not really looking to sell.
So today you announced another acquisition, another purchase. I think it was about 10,600 Bitcoin. And when you announced on a Monday, though, that doesn't mean that you bought it Monday. That means it could have been from the last week or so, correct?
Yeah, we normally announce those things over the course of a week. So on Monday morning, we'll announce what we did in the previous week. This week, we announced, you know, something like, what, $960 million worth of purchases. But a week ago, we also announced about 950 or 960 million in purchases. So about $1 billion a week for the past 2 weeks. So this announcement was everything we did Monday through Friday of last week.
So what factors do you consider when making these purchases?
We buy Bitcoin whenever we have money. I would say tongue-in-cheek, I only buy Bitcoin with the money you can't afford to lose. So this is the 90th purchase. And so we've done it 90 times. It's a very simple way to think of it. So Bitcoin's been going up about 45% a year for the past 5 years. I expect it to go up 30% on average for the next 20 years. It was going up 80% on average 5 years ago. So it's decelerating from 80 to 70 to 60 to 50 to 40, and it should continue to decelerate, towards something like 1.5x the S&P. And so it's not hard to get to a forecast of about 30% over 20 years. But that being the case, the way I think about Bitcoin is it's a digital monopoly on capital. It's the world reserve capital network that's growing 30% a year that you can purchase at 1 times revenue. So if you're the CEO of a company and I came to you and said, I have a monopoly that's growing 30% a year for the next 20 years, and you can buy it at 1 times revenue, the question is, would you do the deal? And of course, the answer is everybody would do the deal, right? If anybody ever said, I have a company growing 30% a year for the next 20 years, and they'll sell themselves to you at 1 times revenue, you're like, well, why are they so stupid? Like, no one's ever that stupid. The last time Google bought a high growth company, they paid 27 times, 30 times revenue, 10 times revenue. Normally you pay 10, 20, 30 times revenue for a high growth company. So a high growth company that'll sell itself at 1 times revenue is a pretty extraordinary deal. Now, for us, though, it's a much simpler decision. It's not just a monopoly growing 30% a year for the next 20 years that we can buy at 1 times revenue. We can buy it risk-free. Okay, well, why can I buy it risk-free? Because my company is constructed for Bitcoin maximalists. The only people that buy my equity are people that believe Bitcoin is going to win and is going to grow 30% a year. If you didn't think Bitcoin was going to grow faster than the S&P index, there's no way you would buy MSTR. Okay, if you thought, that might have been a debate back in 2020, but after the company bought Bitcoin 89 times in a row, if you're still holding the equity, you have to believe in Bitcoin. So when when we buy Bitcoin, we've already stripped the existential risk off of the investment. What matters is not whether anybody else in the world thinks Bitcoin is risky. What matters is, do my equity investors think Bitcoin is risky? And so I'm doing an acquisition which is by definition accretive without risk, and I'm getting the deal at 1 times revenue, right? And we're creating a very transparent credit profile, a very transparent performance profile, and that means that our hurdle rate is 30% risk-free. So, if you were to pitch me anything, if you said, I have the best startup idea ever, I guarantee you 40% a year for the next decade, I would think that's not as good as the deal I have buying Bitcoin. You could promise me 50% a year for the next 20 years. We wouldn't do the deal because I would have to convince 100 outside equity investors that your deal is better than Bitcoin, and I wouldn't be able to convince them, number one. But number two, it would be a dilutive distraction. So we have a very simple business model. It's just we just buy Bitcoin. We expect 30%. We know it'll be volatile. It'll be 30% with 30 vol over 20 years, and right now it's 40, 50 vol. And if you have the ability to just keep doing the same trade over and over again, it makes sense. You could think of it as, maybe one of the all-time great roll-ups where you're just rolling up, a digital asset with a limited supply, and every time you buy a bit more, there's that much less supply in the market, the scarcity goes up. The risk doesn't go up because, let's face it, if Bitcoin goes to 0 tomorrow, it doesn't matter whether I own 1% of it or 2% or 3% of it or 0.5% of it. It's irrelevant, right? I mean, it's kind of like, back to the Manhattan example. If you've decided you believe in Manhattan and you bought 1% of Manhattan, you might as well buy 2 or 4, because if Manhattan sinks under the ocean, you're going to be bankrupt regardless, right? There's nothing you can do if Manhattan sinks, beneath the earth. But, once you've accepted that as the systemic existential risk, and your opinion is Manhattan is not sinking beneath the ocean, then, you've already got a basis, in the city. You've already managed the rest, and the least risky, most accretive thing you can do is just continue on your strategy.
At the Cantor Crypto Conference held here in Miami last month, you mentioned that there are 2 important days in everyone's life: the day they're born and the day they realize why they're here. When did you determine your calling, and how were you certain that it was your existential purpose?
What's interesting is we discovered Bitcoin during the COVID lockdowns when the world turned upside down and interest rates went to 0. And I would liken it to, say you owned $500 million of real estate in a city, and there was a pandemic and the mayor took over, and the mayor decided to reduce all rents to 0 forever for the public good, and then just sent you a memo saying, we expect you to accept 0 rents on your building forever because otherwise you're a bad citizen. And if that happened to you, and if the building was still worth $500 million, you might think, I'm going to sell the building and move to another city where I get respected a bit more because this is offensive, right? Or you could stay in the city and accept 0 forever and go bankrupt, and then people will just ridicule you for being stupid, and you went bankrupt and you probably deserved it. So we got to that point, and I thought, well, the cost of capital went to 0. Jerome Powell literally said, we're lowering interest rates to 0. I'm not even thinking about raising interest rates for 4 years. Like, you go see the press conference. So at that point, I had $500 million, and I thought, it's either a fast death or a slow death, or we're going to have to move, take a risk. We're going to have to transform ourselves and fight our way out of this. So we decided to take our $500 million and buy something where it wasn't rent controlled to 0. And we started looking for a capital asset that was not already highly appreciated. And what I wanted was something like gold, a cross between gold and a monopoly, on a digital monopoly. So I wanted like the Facebook of money, or I wanted Google for money, or Microsoft for money. The best investment ideas have been these the FANG stocks, now Mag 7 stocks, but FANG, Google, Apple, Facebook, Amazon. I thought, can I actually buy a digital monopoly on capital? And Bitcoin looked like the best aspects of Google or Apple, and it looked like the best aspects of gold and a non-sovereign store of value bearer instrument. And I thought, I kind of like the idea of you have portable capital. I give you $1 billion, I drop you in Africa, and I say, buy anything you want, you got to hold it for 30 years. There's not a single thing you would buy in Africa. Not a company, not an index, not a credit instrument, not a currency, nothing. And you wouldn't buy $1 billion in gold because they wouldn't let you out of Africa. They'd steal the gold, right? And so the issue is, what are you going to buy where you need to move the capital asset, right? In the Middle Ages or the Renaissance, people bought art. They bought very, very valuable art from the Italian masters, and they bought it so they could run for their life when they had to flee the city-state when they were the minority. So the struggle for portable property goes back, thousands and thousands of years. It's always been a human problem. So we thought, Bitcoin looks like portable property, but it was digital, and if I had gold. And gold was like portable capital for thousands of years. Like everybody agreed that gold was capital for thousands of years. Even people that wanted to kill each other and hate each other, and they couldn't agree on anything else, they could agree that they wanted to kill you for your gold. Which, by the way, is it's a big deal because in South America, when the Spaniards show up, the Aztecs, the Incas, they didn't actually think of gold was money. The Spaniards did, and they brought the gold back to Europe, where everybody the Spaniards wanted to kill also agreed it was money. And so it was a big deal that people agreed that gold was money. But if you had a genie and 3 wishes and you said, how do you make gold better? You would say, well, first I want to make it impossible to mine any more gold and cap it at 21 million gold coins. And then you would say, I want it to be weightless, invisible, and I want to be able to teleport it. And then the third ask would be, I want to make it programmable so the billion AIs can transform it 1 billion times an hour and send it to another 1 billion computers, and I can put it on 8 billion iPhones and Android phones because that way everybody is going to have this powerful thing, and maybe it'll transform itself in 3,700 iterations over the weekend and make you a lot of money. That's not going to happen with gold. It's not going to happen with real estate. It's not going to happen with soybeans. It's not going to happen with art. It's not going to happen with credit portfolios and security portfolios. So I thought, a digital monopoly on capital asset. We're going to take our 500 million. We're going to buy it. And it was first we were, I would say, was out of desperation and frustration. It's like someone told you you're going to die, and you're like, okay, I guess I will flee for my life with whatever I can take. And then it became opportunistic because the stock tripled, volatility went through the roof, and we could borrow money for free. And so if someone wanted to give you $1 billion for free for 5 years to invest in your business, would you take the money? Yeah, it's like after we were just about to go out of business 6 months earlier, we thought, okay, now someone's going to give us $1 billion for free. We're going to go buy Bitcoin with this money. So then we became the biggest issue of convertible bonds in the world, and we issued like 10, 12 billion dollars of them, and we worked that. But ultimately, I would say that was the opportunistic phase, and in that phase, the product was the equity, and then the tactic was the credit. But we went through these iterations, challenge and response, and necessity is the mother of invention. And so when we borrowed senior debt, we had EBITDA covenants that choked us to death, and so we couldn't do that anymore. And then we did asset-backed financing where we pledged the Bitcoin, and then the bank failed, and the Bitcoin crashed, and that created hysteria, so we couldn't do that anymore. So then we did the $10 billion of convertible bonds, and then we maxed out the convertible bond market, and all the convertible bond buyers ran out of money. And they literally didn't have any more money. We'd just taken too much of the market. And along the way, I learned a lot. I got a PhD in leverage. And what I learned, I became very, when you borrow money and your bank fails, you learn a lot. By the way, it's much better that way than if you get margin called by a bank that's collapsed, that's much better than getting margin called when the bank is healthy, because we got to buy the loan back at a big discount. But I became very disenchanted with corporate bonds and 144A offerings. For those of you who don't know much about it, a 144A offering is an over-the-counter bond issue when you sell it to a bunch of institutions. And it's a really fancy term, and they make it sound good, but here's what it is. It's like one dude in a back alley trading between 37 guys' baseball cards. It's an awful market. Okay, so over-the-counter bonds mean, yeah, you can sell 500 million of bonds. They're liquid. The bid-ask spread is 3%, and they trade 30% cheaper than their fair value. And so I learned, I didn't know anything about this before I got started, but we worked our way through, and I just realized that you're not going to grow the business, and there's no future if you're selling bonds over the counter through the convertible bond market or even the junk bond market. The credit, and then I became more of a, first I didn't understand capital until, a near-death experience, and I had to think about money. Then I didn't really understand bonds until we had worked our way through every part of the bond market, and then I just became very critical of the bond market. I just realized it was crippled. And it occurred to me that most corporate issuers of bonds are issuing crippled instruments for that tactically in order to fund a project, but the credit itself is not good. It's not good to own it. Like it's an awful, if you had a bond that was worth $100 and it traded at $52 and it was illiquid and only traded one day a week, that's not good for you, right? And so we decided that we needed something more scalable, and we went to the preferred equity market, and we created a preferred equity instrument to raise money with the idea that we were going to put together every good idea we'd seen, and we're going to duck the bad ideas. And the good ideas are take the credit instrument public, give it a happy 4-letter ticker, give it a name, let the retail investors and the public investors buy it. The difference between over-the-counter and IPO, over-the-counter means it's illegal for you to buy this instrument. The securities law make it illegal for a normal person to buy it. You have to have $100 million. And let's say you had $1 billion. You still can't buy it unless you actually have an account with the bank that's selling it. Okay, so if I wanted to make it insanely difficult to buy something, I would do it that way. Public means that 200 million people can buy it in 10 seconds. Okay, so it's not like one is a little bit better than the other one. One is good, the other is awful. So we decided we were going to sell a credit instrument to the public. We're going to IPO it. We're going to put it on NASDAQ. But then you think, well, I can't have a 5-year bond that I take public because in 2 years or 3 years, the duration won't be long enough to make it useful. There's not enough liquidity. So we wanted to make it public. We wanted it to be perpetual. We wanted to put a shelf registration on it so we could sell it. There are days when we would sell $45 million worth of this credit instrument in a few hours. We just liquid sell it. We could sell $50 million a day, $100 million a day, whatever. You can't do that with an OTC bond. So we put a shelf registration together with a preferred equity, took it public, backed it with a digital capital asset called Bitcoin. And and then we discovered, we didn't want to pay the money back, right? Because if you're going to borrow the money to invest forever, you don't want to pay the money back. So it turns out that credit investors like to be paid back. And if you don't pay them the money back, they require a higher credit spread. So we ended up, selling these things and offering a 10% dividend at par. And I thought 10% was a lot. And then I thought about it and I realized, well, we're collecting 30%. 10%, if we pay 10 and we collect 30, if you work out the math over 10 years, it works out to 90% of the economics go to the common equity investors and 10% goes to the credit investor. And that's a pretty good deal for the equity. So we paid a bit more and the bug became the feature. And then we discovered that we had inadvertently created the world's best credit instrument. And the product is not the equity, the product is the credit. Because the product we created is a thing you can buy online like STRC that'll pay you say it's 10% dividend. It pays you a 10% dividend and it's a return of capital, so it's tax deferred. So that if you're a New Yorker, it's like a bank account that pays you 22%. If you live in Miami, it's like a bank account that pays you 18%. And of course, who wants a bank account that pays them 18%? And I'm like, yeah, right? Of course, we all do, right? Because currently the money markets pay you 370 basis points and it's taxable. And that's the best it's ever going to get for you, because if you go to Europe, it's 150 basis points. And if you go to Japan, it's 50 basis points. And if you go to Switzerland, it's minus 50 basis points. So now we get to the final punchline, like why were we here? Well, here's what we realized is we can create digital credit and we can strip 80 to 90% of the volatility off of Bitcoin. We can strip somewhere between 80 and 90% of the risk off the instrument. We can pass through 10% or 9 or 11 or 12% return, and we can make it tax deferred. And there's a $300 trillion credit market, and that digital credit pays you 2 to 4 times more than every other type of credit. So if we do that, no reason why you can't just digitally transform 5% of the market, and 5% of $300 trillion now is $15 trillion. It's a lot of money, but by the time we get there, presumably the market's doubled and it's $30 trillion. So it's insane. And then I'll make one more point and I'll stop for your next question, which is, I first realized that Bitcoin was digital capital, but digital capital is like, it's like you got a 3-year-old kid and you give him $1 million worth of real estate in the middle of Brickell. It's dirt, no cash flows. And in 30 years, maybe it'll be worth a lot of money. And if you want to get cash flows out of it, you've got to form a real estate development company. You got to design a building, get a construction loan, build the building, market the building, rent out the building, deal with all the politics and the maintenance, and then maybe you get some cash flows. But not easy for a 3-year-old kid. Not easy for most 30 years old. So if you go to the same kid and you say, or the parent, you say, I'll just give you a credit instrument that pays you $10,000 a month forever, starting now. Okay, well, how many people would prefer to have the credit, right? By the way, the world is, even if the capital asset's going up 30% a year, the better deal is take the capital asset. But most of the people, they can't wait 20 years or 30 years with no cash flow. They want the money. So it turns out that converting capital into credit, that is the mission of the company, in the same way that a real estate developer takes a bunch of raw land and turns it into a building, and either the people are living in the building or the person that's collecting the rents is getting paid some steady income. We realize that we're kind of put here to create that digital credit, and that digital credit is then the stepping stone to the final thing. And the final thing is digital money. And the idea of digital money is not 10% dividend yield with a 10 vol. It's 8 or 7% yield with a 0 vol, right? What if I give you a bank account that pays you 7 or 8% with 0 vol? You put $99.71 in, you get $99.71 out. But until you take the money out, you get 4% more than the risk-free rate in the currency that you live in, right? That is the perfect product. I submit to you, I used to think the iPhone was the perfect product, but the iPhone, you got to actually be able to hold it and look at it, and you got to be awake, or maybe be able to hear, or be able to see. But, a bank account that pays you 8% or 7%, you could be deaf, dumb, blind, in a coma, unborn child. You still want that. You want that for your heirs not born for 20 years, right? So what is it that everybody on earth wants, right? And in the English language, there's a word for what everybody on earth wants, for universal utility, and the word is money, right? You want money, okay? When I give you a bank account that pays you double what SOFR pays you, if I give you double the money market, or if I give you, you live in Japan and I give you 6% or 8% in yen, I'm literally just giving you free money, okay? I know it sounds difficult. It is difficult. It's like building nuclear reactors in order to give you free electricity or 1 penny a kilowatt hour electricity. It's hard, right? You basically have to create a layer of digital capital, not our doing. Then you have to create a layer of digital credit. It takes a lot of equity capital, right? We have 60 billion now. we'll probably have the most digital equity capital in the world forever at this point, because no one's going to catch us on this network. And if you have that credit layer, the last layer, digital money, can be created by partnering with a bank or a money manager. Like, you just basically go to a large bank or a BlackRock or a Vanguard or the likes, and then you create 80% credit, 20% cash equivalents, put a 10% buffer of currency reserves on top of it to strip the last vol each day. And you have just put shock absorbers on the credit, and the credit is, of course, sort of like damped, volatility stripped, risk stripped capital, right? And that's the three-step process. So the day I realized why I was here is I realized we're here to fix the money, right? We're here to give 1 billion people a bank account that pays them 8%, when the rest of the world wants them to take nothing, right? In Switzerland, nothing, right? In Japan, nothing. In Europe, 1%. In the US, about to be 2.5%. When the Fed lowers SOFR to a 2 handle or something, you will be getting 2%. And the actual increase in the monetary system is like 7% a year for 100 years. So if you don't beat 7%, you're just getting poorer in relative basis. And right now, the only way for the average person to beat that is to gamble. You have to gamble on equity. You have to guess. And I'm of the opinion, when you're a 70-year-old retiree, you shouldn't have to gamble. You shouldn't have to gamble on equity. It's not right, right? The entire world somehow decided that capital was buying the S&P index, right? You have to buy a portfolio of equities. And what about just giving people a savings account that actually preserves their wealth, and they don't have to gamble on equities or the like? And so that's what we're here for, right? We're digitally transforming the credit markets, but the big idea is fix the money in the world, and fix the money with technology.